And now to our first conversation. The fifth consecutive month, Nigeria is recording a rise in domestic credit to the private sector. Is this one of the results of CBN's aggressive policy towards expanding credit to the domestic sector expecting? And how has this affected the economy? Well, Michael Oguremi, macroeconomist and fixed income analyst at Chapel Hill Denham, tells us more now. Hello, Michael. Great to have you.
Good morning.
Good morning. So can we say that this is a result of the intentional strategy adopted by the CBN?
Okay, so I think when you look at how credit to the private sector has transcended this year, there are like four key factors I think that have played out. The first would be the current paint high loan to deposit ratio that was recommended by the CBN to commercial banks. You recall that the loan to deposit ratio was, pushed up from 30% to 65%, and I think that sort of has kept commercial banks on their toes to see to it that they are always, within that regulatory limits. I also think another thing that has also pushed the credits is the CBN directive on restricting commercial banks from participating in some domestic issuances in the fixed income space. What we had before was a lot of commercial banks wanted to put their monies in fixed income securities in the Nigerian market, but with the CBN coming out with a directive sometimes last year, to restrict participation in that space, that has sort of improved credit. You also consider the different credit interventions that the CBN introduced, during the pandemic. We had about a 1 trillion, credit intervention to the manufacturing sector, which also boosted, credit in that space. And then I think from the CBN side, those are the three main, major factors pushing the performance. But it's also important to cite the fact that when you look at how banks have performed, if you look at the books of banks, this year to date, you notice that their capacity to lend has sort of improved. When you consolidate, the reserves of bank with, how deposit has also evolved this year, you also notice that their capacity to lend has improved. So I think those are the factors that are pushing the performance of credit so far.
So, and what impact so far would you say this has had on the economy, this increase in credit?
Okay, so to be very honest, I think that it's for a country like Nigeria that is just coming out of a recession with a 0.11 recovery in the first quarter of the year. I think that credit to the private sector was largely instrumental to that. When you consider how much credit need we have in Nigeria, I think that what we've recorded so far in terms of supply has been able to cover most of the needs. If you look at inflation as well, you notice that inflation has been slowing down, currently at 17.75 as of June. I also think that, credits to the private sector in this case would focus on maybe the manufacturers and other producers. I think that has also enabled them to produce more to sort of keep inflation abated. When you look at purchasing managers index, you notice that for the month of July, as at what the CBN specified at the last MPC meeting, they noted that it has improved to about 46.6 points compared to 45.5 points we had in June. And that expansion also speaks to the fact that we have been at credit to the private sector has sort of trickled down, to activities in the manufacturing sector. So overall, I think that the improved credit to the private sector has had a very positive impact on the economy.
All right, and commercial bank lending remains a major component of this total. What about the issue of interest rates?
Okay, so when you look at interest rates, I think it's a factor to consider. While it's quite great that we are recording improvement in credit so far, I think that the interest rate is still high, currently at about 29.5%, and that the maximum lending rate is about 29.5%. But where I'm concerned is the fact that there is a wide margin between what bank charge as prime lending rate and what they charge as maximum lending rates, right? I think that margin is a lot. If you check the recent statistics, you notice that it's currently about 18%. So what it means is that a commercial bank would most likely, charge about 12%, 12% thereabout to low risk, to their low risk customers, and then charge about 30%, to high risk customers. It's safe to say that there should be a margin, but I think that margin is too wide, and I think that is a constraint. Is a future constraint to growth. I think the gap between those two rates are very wide. And another point to also note is what exactly are the rates we have on savings, because for a bank to lend, they must have deposits. And what encourage people to say, what encourage deposit the savings? And savings would also be a fallout of what exactly is the interest that people are getting on their savings deposits. Currently, savings deposit in Nigeria is quite low, and I think that is sort of discouraging, people to save. You recall that sometimes last year the CBN came out with a directive to, cut, to slash by some margin, the rates we had on savings deposits. And if you look at the transition of savings from then to now, you notice that there has been, not so much too, but there has been some sort of reduction in savings, which means that the willingness to save, is rather low in Nigeria. So you have most people wanting to put their money in, investments rather than putting it as deposits, in savings deposit with the bank. And so it's important not just to say the lending rate is high, but to also say that, the rate on savings, the savings interest rate is quite low.
Yeah, in fact, sometimes I wonder if there's still any interest on savings. You hardly notice anything on that. But, I mean, you did note that the disparity between the interest rate to low-risk customers and high-risk is quite high, from 12% to 30%. What, from your perspective, can be done to bridge this, or is this the way it should be?
Well, I think the only thing that can happen in that space would be, there are two ways to go about it. Number one would be to have a fresh directive from the CBN. However, I don't think the CBN would like to go that route, because what it means is they are going to be, tapering the profitability of banks, which I don't think the CBN will want to do at a time like this. However, if it's a risk that they want to take, it would mean that they would need to put out a regulation to say, okay, we think that you need to sort of like reduce the gap between, the rate you charge to low risk customer and what you charge to the high risk ones. The other thing that can be done is to de-risk lending. Right, and what I mean by that is the reason why the banks are charging as low as 12% to low-risk customers and as high as 30% to high-risk customers, because of the risk, that the high-risk customers pose to them. And I think that that risk is a fallout of the fact that they've had, number one, non-performing loan in the past. There is also the concern about, will they be able to repay if we give them a fresh loan because of how the macroeconomy is performing. So I think that the government also has a role to play in terms of de-risking the macroeconomy to ensure that smaller businesses who are applying for loan can have better credit rating by banks before those banks give them the loans. That is what also help shrink the gap that we're currently seeing between the prime lending rate and maximum.
Okay, and let me also take you up on the issue of the interest rates, which you mentioned. Are the banks losing anything at all? We've noticed that savings has reduced because the interest rate is not so attractive. Are they losing anything at all?
So I would say no. And the reason, my argument has always been that for banks, they have multiple sources of revenue. You have the electronic channels where they make money from. You have the interest that they charge on loans. You have investment in financial instruments and several other sources. So what happens? I mean, what happens most times is when there is a regulation that sort of tapers their profits in a particular segment, they fall back on other segments to sort of augment and close out that gap. So I don't think banks are really feeling any dire effects from the fact that savings is reduced, or they have quite low deposits to give out as well. I really don't think so.
All right. According to the NBS schedule, the net inflation data should be released today. FDC sees it tapering to about 17.5% in July from 17.75% recorded in June. What's your forecast?
Okay, so for us at Chapel Ibrahim, we have a forecast of 17.53% as well, and that is our premise is the fact that there really isn't any major shocks to the economy. And if you look at it, the only one that could have been a concern would have been the CBN coming out to say that they are discontinuing the sale of FX to BDCs. So our concern then was that it's possible that, because we would have panic buying, it's possible that we might have, the parallel market exchange rates soaring very high, and that could sort of trickle into, inflation for the month of July. But what we saw after the announcement was the CBN coming out to supply about $200 million to banks, which sort of quelled, the liquidity pressures that we had in the system at the time. And so, whilst we were anticipating interest exchange parallel market exchange rates to go very very high, we saw it range bounding between 510 and 520. So it's not, we didn't really see much more reaction like we expected it to see. And because of that fact, we can as well isolate that factor and say that, well, we didn't really have any major shocks, for the month of July. So it is based on that, on that development that we came out to see. We are coming out to say that, inflation will most likely close out at 17.53%, barring any shocks.
Okay, but talking about inflation figures these days seems to be well, different from the reality, because that's the reaction we get from a lot of Nigerians when we say inflation is tapering, and yet on the outside, in the reality, in the real world, we don't seem to feel it. Is there a way to connect this to explanations?
The only way to connect it would be to revise how inflation is computed. If you check the MBS mode of computing inflation, you notice that there is a basket of commodities, and each of those commodities have weights, that are being used to determine what headline inflation eventually prints at. I think that it might be a timely step to sort of recalibrate those weights, to tilt it more to probably to goods that consumers are consuming more. Because just like you said, there is a disconnect we have between what is reported as inflation and then what obtains in reality. So it might be a good time to recalibrate those weights and say, okay, maybe we push we put a higher weight on commodities that consumers are consuming more. The other thing I think that can be done is to look beyond just using inflation as a measure of how price development has moved, to begin to use something like consumer sentiment. So just like the way you have the purchasing managers index tracking how the manufacturing sector perform, we can have a replica of that, in which case you have on a monthly basis you have responses and views, from the portfolio of consumers, saying how inflation has affected them, and then that can be printed. So it's not going to be a substitute; it's going to be a complement to what we currently have. So you have inflation still being released, but you have some sort of market sentiments that is also printed alongside with that, which shows how an average consumer in Nigeria feels about price development for the month. I think that's sort of portray reality much better.
All right, let's look at the external buffers. Now, Nigeria's foreign exchange reserve has sustained its accretion for the fifth consecutive week, but has now started a decline at August 11 this week on week to 33.59 billion. What factors boosted the rise, and what changed?
Okay, so I think that when you look at how the external reserves evolved, it was quite surprising. For me as a person, I really didn't see that coming so quick. But I think what improved the external reserves would be the fact that the CBN sort of slowed down a bit on FX intervention slow down the pace of intervention in the FX space, right? So compared to what we had in 2020, where the CBN was supplying much more, 2019, 2020, where they supplied much more on a regular basis, down to 2021, between April, May, June, thereabouts, we've seen them slow down on supply to the FX market, and that has helped them to sort of, improve the level of external reserves. Now, in terms of, the recent decline we have, I'd say it's too early to call. I think it's important to, hold back the clause and see how well or how far the decrease we're currently seeing will persist. I don't see it persisting for so long because of the fact that the CBN is expecting SDR allocations from the IMF as high as about 3 billion coming in to support the external reserves. And I think that when that comes in, we'll see extra accretion to the reserve, about 10% compared to what we're currently seeing. So I think I don't think the decrease we're currently seeing is anything to be worried about, considering the inflows we are expecting.
All right. Well, I will take your word for it, at least for now. We'll not get worried and hope that the decline is just a temporal thing and it will soon be over. Well, I need to thank you so much, Michael Ogunremi, macroeconomist and FI analyst at Chapel Hill Denham, for sharing your thoughts with us this morning.
Thank you very much.
So we'll take a break now. After the break, we'll discuss infrastructure development funding and the federal government's just approved toll policy. Do stay with us. It's Business Morning on Channels Television.